Welcome to our conversation on financial reporting. The focus of this session is to understand dividend and observe dividend of some Indian companies. Whenever we say dividend, we talk about cash dividend or a stock dividend. But the focus of this session will be on the cash dividend only. So whenever a company declares dividend, the dividend has to follow, the company has to follow certain conditions given in the Companies Act. But before we go to the Companies Act provision, let us understand a very generic definition of dividend. Dividend is a distribution of profit among the shareholder. And the distribution can be in the form of cash or maybe in the form of stock or shares. If it is in the form of cash, it's called cash dividend. Otherwise, it's called stock dividend. So conditions for declaration of the cash dividend. A company can declare dividends only out of the current profits after providing for the depreciation. This is the first condition. Or it can also give dividends from the profits of the previous years, which are called retained earnings after depreciation, or a combination of both. So a company can give dividend from the current profits or from the previous year's profit. But definitely it has been mentioned that the profit should be after the depreciation and of course the tax. And most of the cases, the Act also says that there is a need for a board or a shareholder's approval. If it is interim dividend, that means the dividend declared between the two AGMs, then board can declare it. But final dividend, there is an approval of the AGM is required through ordinary resolution. Those are the corporate laws compliances. And moreover, it also says that the dividend must be paid within 30 days of its declaration. And if not paid, the company and officers may be penalized. So there is a very clear indication that you just cannot declare and leave it as a liability on your balance sheet. It's also important to understand a very basic question comes to mind. Can a company declare dividend when there is a negative profit or a negative PAT? If the current year's profit is a negative PAT and there are no accumulated free reserves, then the company cannot declare dividend. So if there is a current year negative PAT and also there are no accumulated reserves or accumulated reserves are negative, then the company cannot give cash dividend. However, a company can declare dividend even if there is a loss, only if there are free reserves. Free reserves means the accumulated profits for the past year. And certain conditions about the cap, the amount of dividend to be declared need to be fulfilled. So in principle, if there is a negative PAT and no free reserve, no dividend. But if there is a negative PAT and there are free reserves, then the company can give dividend and but following the rules and conditions about the cap. What is that cap? The rate of dividend cap, the amount to be withdrawn from the reserves in the cap, and the cap is on the balance in the reserve. Three conditions. The average rate of return should be average of the 3 years dividend. So there has to be, if the company has not declared dividend in the last 3 years, of course you cannot give dividend. The balance in the reserve, amount to be withdrawn from the reserves, should be less than the 10% of the paid up capital and free reserves. Company cannot withdraw and pay more than 10% of that. And the balance in reserve post-withdrawal, the balance in reserve should be greater than 15% of the paid up capital. So, to summarize, if there is negative PAT and no reserves, then no cash dividend. But if there is negative PAT and there are positive reserves, positive accumulated profits, of course, the company can distribute cash dividend following fulfilling certain conditions. There is a concept of special dividend. It's one type of an interim dividend. Several companies, particularly companies with deep pockets, huge cash sitting on the balance sheet, often declare special dividend. And we'll see some cases of special dividend in Indian companies. This is a one-time payment made by the company to its shareholders. It is in addition to the regular dividend. Okay, it's in addition to and it is typically declared when a company has excess cash or extraordinary profit, and this is not expected to be recurring in nature. It's a different matter that companies like TCS keep on giving special dividend, but in principle, it is expected that a company will not keep on giving special dividend. So distribution of dividend, if you can see that, cash dividend, leads to reduction in cash because there's a cash outflow. Because the dividend is from the free reserves, the other equity reduces. Because the other equity reduces, the total equity of the firm falls. And there is no change in the number of shares, so the book value per share falls. So all other things remaining constant, the declaration of the cash dividend leads to fall in the book value per share. Fall in the book value. Therefore, it affects the price also. So what is this book value? Book value is the total equity by number of shares. And the total equity is a capital plus other equity. And other equity includes that reserves, retained profits. So the equity falls because the retained earning falls. The number of shares stays the same. Therefore, the book value per share falls. That is why we say book value per share falls. And whenever a company declares dividend, the default interpretation, it is as a percentage of the face value, not as a percentage of the market value. The rate of dividend is always shown as a percentage of the face value, not as a percentage of the market value. That will become dividend yield. And whenever a company declares dividend, we can an hypothetical impact on the financial statements. In the cash flow, there is a payment, 25,000, and the dividend is shown as a reduction in the other equity in the statement of changes in equity, and the balance of other equity will appear on the balance sheet. So this is just to show the interrelationship between the financial statements and also the impact of the dividend on the financial statements. Now let us see the dividends of some Indian companies, high-paying dividends, companies which have paid high dividends in the last few years. One of them is a Vedanta Limited. And Vedanta Limited is a subsidiary of Vedanta Resources, which is an UK-based company. And in 2025, Vedanta Limited declared 1600% dividend. The face value is 1. The paid up capital is 391 crore. Okay. And the amount of dividend, therefore, is calculated on the paid up capital. So the amount of dividend is 6,256 crore. And this dividend, 6,256 crore, is a cash outflow from Vedanta Limited. And This 6,000 out of 6,256 crore, the parent company, Vedanta Resources, which holds about 56% of Vedanta Limited, gets 3,500 crores approximately. So 3,500 crores of cash is transferred from Vedanta Limited to Vedanta Resources, which is a foreign company. So cash outflow in 1 year, 3,500. In fact, if you observe last 10 years balance sheets and cash flows, more than 50,000 crore has been transferred, has been distributed as a cash dividend from Vedanta by Vedanta Limited to Vedanta Resources. I won't hesitate to use this as a flight of capital, 50,000 crore. And Vedanta Resources acquired Sheshak Goa in 2007. And then it renamed it as Vedanta Limited. Maybe in one of our presentations, we'll see the acquisition of Sheshak Goa by Vedanta Resources. So 1,600% dividend on the capital. That is what we said, that capital, the dividend is always calculated on the face value. And a significant part of this money goes to the parent company. The dividend declared, which is, this reduces the cash and equity, cash outflow, reduction in reserves, so therefore reduction in equity. Consequently, the book value per share has come down from 105 to 89. The Vedanta Limited's book value per share has gone down. Now let us see another company which has been regularly paying dividend, TCS. In the last 5 years, we can see that the dividend per share has gone up from 15 to 126. Face value is 1. So as a percentage, the rate of dividend has gone up from 1,500 to 12,000%. TCS has been regularly paying dividend, and the amount of dividend as a percentage and absolute amount keeps on rising. And out of this, in the last 3 years itself, Tata Sons, which is the largest shareholder of TCS, has received around 82,000 crores as a dividend. So Tata Sons, the major shareholder of TCS, has received 82,000 crore from TCS in the last 3. So in Vedanta Limited, it's a transfer of money from an Indian company to a foreign company. And in case of TCS, transfer of money from a listed company to an unlisted company. Tata Sons till today is an unlisted company. And interestingly, this dividend, you can see this is dividend per share, includes a special dividend. As I mentioned previously, Tata Consulting, TCS, often declares special dividend because of the huge liquid cash available on the balance sheet. In latest year, 2024, 25, there was a special dividend of 66 per share, 24,000 crore, and it was announced on January 2025. 18 rupees per special dividend, which is 6,500 crore, announced in January 24, and 67, again 24,000 crore in January 23. So every year in the month of January for the last 3 years, we can see that TCS has been declaring special dividend. And a significant portion of this dividend, as I mentioned, goes to the shareholder. The major shareholder is a Tata Sons. We also discussed that the Companies Act allows a loss-making company to declare dividends. Are there any such examples in India? Yes. There are several such companies. EID Parry India Limited reported a standalone loss of 428 crore in 2025. Despite this loss of that year, the company declared 900% dividend, 9 rupees per share on a face value. So the amount of dividend distributed is 160 crore. Company made a loss of 428 crore, but declared a dividend of 160 crore. And the promoter, which holds about 41%, received 66 crore. So a loss-making company declared the dividend, and a significant portion of the dividend goes to the promoter. Is it illegal? No, it's allowed. But understand the intention behind. It's one-way transfer of money. Similarly, Aditya Birla Real Estate also declared dividend of 22 crore despite having a loss of 15 crore. That means they are actually declaring out of the previous free reserves. It's interesting that both loss-making companies and profit-making companies keep on distributing dividends, and that is one way of giving money to the shareholders, and the majority of the shareholders receive that money. Nifty 50 companies in the last last few years, we can see that significant amount of dividend has been declared. In the last year, 2025 itself, 2.7 trillion, okay, 2.7 lakh crore dividend has been declared by the Nifty company. So dividend is a very important way of distributing, of course, and also transferring money to the parent company. Thank you very much.